Let's look at some disadvantages of FIFO. So we'll start with it's inaccurate. It's actually kind of a made-up number. Basically, it's an assumption where we never or rarely get the actual cost of sale right. And the important thing is we don't really care because it should all balance out. But that is a disadvantage. We're actually not accurate 100% on every transaction. It's also inflexible. What if stock prices did go down? Well, FIFO is going to have to assume that we're going to sell the dearer stock, which is the older stock, first. It limits decision making. What if the firm actually doesn't want to sell the older stock today? Well, FIFO will still assume it does. And FIFO will decrease net profit in the short term during times of falling stock prices. So let's just have a look at that. This is the exact opposite situation of before. What we've got here is stock coming in the following order. We bought these units first at 20, and then stock prices got cheaper. They got cheaper to $10. So business B will have the same stock in the same order, like so. Let's look at our sales. We're selling them for $30 again. Business A is going to show FIFO or use FIFO. Business B is going to use LIFO. So after one sale, we've got $30, cost of $20 for business A, but that's a profit of $10. And business B, its cost, because it can use LIFO, why don't they just go and take the cheapest stock first? Whereas with FIFO, you're bound to take the first item in, which was the most expensive one. So the effect that will have will be to lower profit. Find that example through, we can see up to 5 units, we're going to have a much lower net profit for FIFO. So in this case, we can see after 5 units, we've got a cost of sale here of $80, which leaves a net profit of $70. Because stock prices have gone down, but with FIFO, we can't take advantage of that. Why? Because we need to assume we're getting rid of the older stock or the more expensive stock first. Whereas business B, it's not limited by that. It can take the last stock in this case the $10 stock, and that'll end up giving it a lower cost of sales and a higher profit. Again, what's interesting to note is that after 6 units, it would all balance out again to $90. So, looking at that again as a graph, after 1 unit, business B had a higher profit of 10. After 2, business B had a higher profit of $40 to 20. After 3, it was higher. 4, it was higher. 5, it was higher. And then lastly, you can see it will round out again. But for most of that period, business B did have the higher net profit. And that was because it could sell the cheaper stock first, even though it was older. And that's one of the limitations of FIFO. So you can see here, if stock has gone down in price over time, well, we're kind of limited with FIFO because we need to assume we've got to get rid of all of this older stock, which is more expensive first. So in the short term, we're going to have more expensive stock being sold, which is increased cost of sale, and that lowered our net profit. And important to realize that it's only short term. Once all stock is sold, net profit was identical.